Most people will lose more money this year by doing nothing than by doing something wrong. Right now, in the first week of January, your brain is wired for action. You feel motivated, ready, but within 14 days, that window closes. The decisions you don't make this week will haunt your bank account for the next 12 months. Here's what nobody tells you. The difference between people who build wealth and people who stay broke isn't discipline, it isn't willpower. It's a 60-minute window in early January where they lock in decisions that remove willpower from the equation entirely. You have 7 days. Let me show you something that will make you uncomfortable. The average person makes a financial resolution in January. Maybe it's to save more, invest consistently, build an emergency fund, cut unnecessary subscriptions. By February 12th, 92% of them have already quit. Not because they're lazy, not because they lack information. They quit because they were fighting human nature with a strategy designed to fail. Here's the truth. Your brain doesn't want you to invest. It doesn't want you to save. It's wired for immediate survival, not long-term wealth. Every time you try to stay disciplined or build better habits, you're fighting 2 million years of evolutionary programming that tells you to prioritize today over tomorrow. This is why intelligent people stay broke. This is why high earners live paycheck to paycheck. This is why you know exactly what to do, but still don't do it. The problem isn't knowledge, it's psychological architecture. And the only way to win is to stop fighting yourself and start building systems that make the right choice automatic. Let me tell you about the investor's paradox. The average stock market return over the last century is about 10% annually. Compound that over 30 years, and a single $10,000 investment becomes $174,000. Do nothing, just hold. But the average retail investor, they earn around 3.5% annually. Same market, same opportunity, completely different outcome. What happened? They quit. Not all at once, not dramatically. They just stopped contributing during a downturn, pulled out after a bad quarter, checked their portfolio obsessively during volatility, and made an emotional decision that cost them decades of compounding. Here's what's maddening. Most of them knew better. They'd read the books, understood compound interest, believed in long-term investing. But when the moment came, when the market dropped 15% and every financial headline screamed panic, they sold anyway. Why? Because knowledge doesn't override emotion. Information doesn't beat instinct. You can intellectually understand that market downturns are buying opportunities, while emotionally experiencing them as existential threats. And emotion always wins. This is the invisible wall that separates people who build wealth from people who just think about building wealth. It's not what they know, it's how they've structured their financial life to remove emotional decision-making from the equation entirely. Let me break down the 4 psychological traps that destroy investors. Trap 1. Impatience. You invest $500. A month later, you check the balance. It's $503. Your brain does instant math. If I keep this up for a year, I'll make $36. I can make that in an afternoon doing freelance work. So you stop. You redirect that $500 towards something with faster feedback, a side hustle, a course, something that feels like progress. What you didn't see, that same $500 monthly investment compounded at 8% over 30 years becomes $679,000. But your brain can't feel compound interest. It only registers immediate results. Trap 2. Loss aversion. Behavioral economists have proven this repeatedly. The pain of losing $100 is psychologically twice as intense as the pleasure of gaining $100. When your portfolio drops 10%, you feel it as a visceral threat. When it rises 10%, you barely notice. This asymmetry makes you hypersensitive to downturns and numb to growth. So, during the inevitable market correction, you check your account, see red numbers, and your nervous system interprets it as danger, not opportunity. Danger. You don't make a logical decision, you make a survival decision, and you sell at exactly the wrong time. Trap 3. Comparison. You start investing. 3 months in, you're up 4%.
Then you see someone on social media talking about a crypto play that returned 40% in 3 weeks. Someone else flipped a house and made 6 figures in 6 months. Your friend mentions their startup equity is about to vest. Suddenly, your 4% feels pathetic, boring, like you're being left behind. So you abandon the plan, chase the bigger, faster, sexier opportunity, and usually you lose. What you didn't realize, the people showing off their wins never show you their losses. That crypto investor lost 60% the next month. The house flipper worked 80-hour weeks and barely broke even after costs. The startup equity might never be worth anything, but you only saw the highlight, and comparison made you quit a winning strategy to chase a lottery ticket. Trap 4. Boredom. This is the silent killer of long-term investors. Wealth building is boring. It's the same decision repeated hundreds of times over decades. Transfer money, buy index funds, don't check the account, repeat. There's no drama, no excitement, no story to tell at dinner parties. Your brain craves novelty, stimulation, progress you can see and feel. Compounding offers none of that. So people quit because investing stops working. Not because investing stops working, but because it never feels like it's working. They need action, movement, the emotional satisfaction of doing something. And that need for stimulation costs them everything.
Here's what most personal finance advice gets wrong. It tells you what to do. Invest 15% of your income. Max out your retirement accounts. Build a 6-month emergency fund. Buy and hold index funds. All of that is correct, mathematically sound, proven by decades of data. But it's useless because knowing what to do and actually doing it are separated by the largest gap in personal finance. That gap isn't filled with more information. It's filled with emotional regulation, decision fatigue, and behavioral architecture. Let me explain what I mean. Every financial decision you make carries an emotional cost. Deciding to invest $500 this month means deciding not to spend it on something you can enjoy today. Watching your portfolio drop during a correction means tolerating psychological discomfort with no clear end date. Staying consistent for years means resisting boredom and the constant temptation to do something when doing nothing is optimal. Most people try to solve this with willpower. They think, I just need to be more disciplined, more committed. I need to want it more. But willpower is a finite resource. Decision fatigue is real. Emotional discomfort accumulates, and eventually you break. Not because you're weak, because you're human. The people who actually build wealth don't have superhuman discipline. They've just removed the need for discipline entirely. They've automated their investments, so the decision never reaches conscious awareness. They've structured their accounts so they can't easily access the money during moments of panic. They've committed to strategies so boring that there's nothing to tinker with, nothing to optimize, nothing to improve. They've made wealth building invisible. And that invisibility is exactly what makes it work. Let me give you a different frame for this. Most people think the goal of financial planning is optimization. Find the best investment, the highest return, the perfect allocation. That's wrong. The goal of financial planning is to reduce the number of decisions you have to make. Every decision is an opportunity to fail. Every moment of conscious choice is a moment where emotion can override logic, where willpower can falter, where you can talk yourself out of doing the thing that works. The investor who makes 0 decisions after their initial setup beats the investor who constantly optimizes. Why? Because the optimizer is in a relationship with their portfolio. They check it, tinker with it, read articles about it, feel anxious about it, make adjustments based on how they feel that week. And feelings are the worst possible input for financial decisions. The person who said it and forgot it, they're not smarter, they're not more disciplined. They just removed themselves from the process. They made one decision that eliminated the need for 1,000 future decisions. That's the insight most people miss. Wealth isn't built by making great decisions consistently. It's built by making one great decision that makes all future decisions irrelevant. And that decision must happen now, in this psychological window, before motivation fades and the inertia of your current life takes over. Here's where we are. You understand why most people fail at investing. It's not ignorance, it's psychology. You understand the traps: impatience,
loss aversion, comparison, boredom. You know how they manifest. You've probably experienced them yourself. You understand that willpower isn't the answer, that discipline will fail you, that the only sustainable path is to build systems that remove decision-making from the equation entirely. And you understand that this week is the window, the moment of maximum leverage, the brief period where your brain is wired for change before inertia reasserts itself. But here's what we haven't answered yet. What are the actual decisions? What specifically do you do in the next 7 days to lock in a year of financial progress? That's what we're about to cover. And I need you to understand something before we go further. These aren't the decisions you think they are. Most financial advice focuses on the obvious. Open a brokerage account, set up a budget, start an emergency fund. That's table stakes. Everyone knows that. What I'm about to show you are the decisions that separate the people who follow through from the people who fade out by March. The structural choices that make everything else automatic. The counterintuitive moves that eliminate emotional interference. Some of these will feel uncomfortable. They require confronting truths about your own behavior that most people would rather avoid. But if you're still watching, you're not most people. If you've made it this far, drop a comment and let me know what's the financial decision you keep postponing. What's the thing you know you should do but haven't done yet? I read every comment, and I want to know what's actually holding you back, because what comes next will only work if you're brutally honest about where you're starting from. Let's continue. Here's the question nobody asks. Why does investing start working exactly when it feels like it stopped working? Look at the data. The first year of investing feels like nothing. You contribute, you check your account, the numbers barely move. Your effort feels disconnected from the outcome. Year 2, same thing. Maybe you're up a little, maybe you're down. It's all noise. Year 5, you've put in thousands of dollars. Your returns might be decent on paper, but they don't feel life-changing. They don't feel wealth. This is where most people quit. They don't announce it. They don't make a decision to stop. They just drift away. Miss a contribution, then another. Eventually, they stop looking at the account altogether. And here's what kills me. They quit 3 years before the inflection point. Because somewhere around year 7 or 8, something changes. The returns start to feel real, not just percentages. Real money. Money that compounds faster than you can contribute. By year 15, your investments are doing more work than you are. By year 20, it's not even close. But you only get there if you survive the first 8 years, the years where nothing seems to happen. Let me show you what you're actually building when you invest. Most people think investing is about returns. Pick the right stocks, time the market, beat the benchmark. That's not what's happening. When you invest consistently over time, you're not building a portfolio, you're building a machine. In the early years, that machine is pathetic. It's slow, inefficient. You pour money in and it barely moves. You're doing all the work, and the machine is just sitting there, humming quietly in the background. This is by design. Compounding doesn't start strong. It starts invisible. Here's the math that your brain can't emotionally process. In year 1, if you invest $500 monthly at 8% annual returns, you'll end the year with about $6,150. You contributed $6,000. The machine made you $150. That's 2 dinners, a tank of gas, nothing. Year 5, you've put in $30,000. Your balance is around $36,700. The machine made you $6,700. That's real money, but it's still small compared to your effort. But watch what happens in year 15. You've contributed $90,000. Your balance is $170,000. The machine made you $80,000. For the first time, the machine has generated nearly as much wealth as you have. And now it accelerates. Year 20, you've contributed $120,000. Your balance is $294,000. The machine made you $174,000. It's now out-earning you. Year 30, you've contributed $180,000. Your balance is $679,000. The machine made you $499,000. You did 1/3 of the work. The machine did 2/3. This is what people miss. You're not just saving money. You're building a system that eventually takes over the job of building your wealth. But it takes 8 to 10 years before you feel it working. Here's the trap. In years 1 through 8, investing feels like failure, not because you're losing money, because the feedback is so delayed and so disconnected from your effort that your brain interprets the lack of visible progress as evidence that it's not working. Let me give you an analogy. Imagine you're planting a tree. You dig the hole, plant the seed, water it every day. For the first 3 years, nothing visible happens above ground, just a tiny sprout, barely noticeable. If you judged the tree by what you could see in year 3, you'd think you wasted your time. But underground, the root system is exploding, spreading, building the foundation that will eventually support a massive tree. The growth is happening, you just can't see it yet. Compounding works the same way. In the early years, the returns feel insignificant because they are insignificant relative to your contributions. You're building the base, the foundation, the root system. But that base is what allows exponential growth later. Most people quit because they're measuring the tree by its visible height in year 3. They don't realize the real growth is happening where they can't see it. And the moment they quit is the moment they kill a system that was 3 years away from becoming obvious.
Let me show you what quitting actually costs. Same scenario, $500 monthly, 8% returns. Investor A starts at age 25 and invests until age 35, 10 years, $60,000 contributed. Then they stop, never add another dollar, but they leave it invested. Investor B waits, starts at age 35 and invests until age 65, 30 years, $180,000 contributed. Who has more at retirement? Investor A, by a lot. Investor A ends with $520,000. Investor B ends with $679,000. Wait, that doesn't seem right. Investor B contributed 3 times as much money over 3 times as many years and only ended up with 30% more? Exactly. Because Investor A gave their money time. They let the machine run for 40 years, even though they only fed it for 10. Investor B tried to make up for lost time by contributing later, but time is the one variable you cannot buy back. Here's the gut punch. If Investor A had kept investing for the full 40 years instead of stopping at year 10, they'd have $1.55 million. That extra $120,000 in contributions from age 35 to 65 would have generated an additional $870,000. This is why quitting early is so catastrophic. You're not just losing the contributions you didn't make, you're losing the decades of compounding those contributions would have generated, and you can never get that back. So let's talk about boredom, because this is the real killer. Not market crashes, not bad returns, boredom. Investing is boring, aggressively, relentlessly boring. Every month, same decision. Transfer money, buy index funds, close the app, repeat. No dopamine hit, no progress you can see, no story, no excitement, and your brain hates it. But here's the reframe. Boredom is the signal that you're doing it right. If investing feels exciting, you're doing something wrong. You're trading, speculating, chasing, gambling. Excitement in investing is expensive. It means you're making emotional decisions, taking unnecessary risks, paying attention when you should be ignoring. The best investors are bored. Their strategy is so simple, so automated, so hands-off that there's nothing to do, nothing to optimize, nothing to check. And that boredom is what allows compounding to work. Because every time you interfere, every time you tinker or adjust or improve your strategy, you're interrupting the machine. You're resetting the clock on compound growth. The portfolio that gets ignored for 30 years beats the portfolio that gets optimized every quarter. Boredom isn't a bug, it's a feature. If you're bored with your investments, congratulations, you've built something that works without you. Here's the timeline nobody prepares you for. Years 1 through 3, confusion. You don't understand if it's working. The numbers are too small to feel real. Years 4 through 6, doubt. You've contributed a lot. The balance is growing, but slowly. You start wondering if there's a faster way. Years 7 through 9, boredom.
The strategy's working, but it's painfully unexciting. You're tempted to quit and try something more interesting. Years 10 through 12, recognition. The machine is starting to pull its weight. Returns feel significant. You realize this might actually work. Years 20 plus, inevitability. Wealth feels inevitable. The machine is unstoppable. You stop thinking about contributions because they barely move the needle anymore. Most people quit somewhere between year 4 and year 9. They quit right before recognition, right before momentum, right before the system they built starts to justify all those years of boredom and doubt. And the tragedy is, they don't know how close they were. They think they failed. They think investing didn't work for them. They think they weren't cut out for it. But they didn't fail. They just stopped too early. They planted the tree, watered it for 5 years, then walked away 3 years before it started producing fruit. So here's the mental model that changes everything. Stop thinking of investing as a way to get rich. Start thinking of it as a way to become unfireable. Most people approach wealth building with the wrong frame. They want to accumulate a big number, hit a milestone, achieve financial independence. That frame makes every year feel like failure because you're nowhere near the goal. Instead, think of every contribution as buying yourself options. With zero invested, you have no options. You need your job. You need your paycheck. You cannot take risks. You cannot say no to a bad situation. With $10,000 invested, you have 1 month of options. You could quit a toxic job and take a month to find a new one without panic. With $50,000 invested, you have 6 months. You could take a sabbatical, retrain, pivot careers. With $200,000, you have 2 years. You could start a business, move to a new city, make a major life change without financial terror. With $500,000, you're functionally unfireable. You don't need permission from an employer to live your life. Every dollar you invest is buying you freedom, not someday, right now. Because even small amounts of invested capital change the power dynamics in your life. You walk into negotiations differently when you have 6 months of expenses invested. You make career decisions differently when you're not desperate. You take risks differently when failure doesn't mean catastrophe. This is where compounding really does. It doesn't just make you wealthy, it makes you free. And that freedom is worth the boredom, worth the slow years, worth the doubt. So what do you actually do this week? Not a list, a framework. Decision 1. Pick a number you can contribute every month without thinking about it. Not an aspirational number, a boring, sustainable number. Decision 2. Automate that contribution. Make it happen before you see the money, before you can spend it, before you can change your mind. Decision 3. Choose the simplest possible investment, an index fund, a target date fund, something so boring you'll never be tempted to tinker with it. Decision 4. Delete the app from your phone. Seriously, you don't need to check it. Checking it only creates opportunities to make emotional decisions. Decision 5. Commit to ignoring it for 1 year. 1 full year of contributions without looking at the balance. Let the machine run. That's it. 5 decisions, 1 week, then you're done. You've built the system. Now you let time do the work. Because here's the secret. The hard part isn't the first week. The hard part is year 6, when you're bored and nothing feels like it's happening. But if you make these decisions now, if you structure the system correctly, you won't need willpower in year 6. The machine will be running whether you're paying attention or not. And by year 10, you'll look back at this moment and realize this was the week everything changed. Not because you did something dramatic, because you made 5 boring decisions that compounded into a different life.
Most people never build wealth because they're waiting for the moment when it feels right, when they have more money, more knowledge, more confidence. That moment doesn't come. The only moment that matters is this one, right now. The first week of the year when your brain is wired for change and inertia hasn't taken over yet. You know the traps. You understand the timeline. You see the machine you're building. Now you just have to start. If this reframed how you think about investing, leave a comment. Tell me which year you're in right now. Year 3?
Year 7? Year 15? And if you haven't started yet, tell me what you're committing to this week. Because the only thing worse than starting is knowing you should start and choosing not to. 7 days, 5 decisions, 1 system. Build the machine.